Welcome everyone. This is the third webinar in our series of the wealth space. Our topic for today is helping your children get into the property market. My name is Kelly Kennedy. I'm a financial advisor at BDO Private Wealth Advisers here in our Sydney office. And today I'm joined by Shaun Haden.
Hi everyone, I'm also a financial advisor here at BDO and I'm based in our Brisbane office.
Thanks for joining us today, Shaun. So before we kick things off, I would like to draw everyone's attention to our housekeeping slide. To start off with, everybody is automatically muted. We will have time for questions at the end though, so you can submit these. There is a question tab that I've just highlighted, and then if we run out of time to respond during our session, we'll respond to you subsequently in due course. And then if you're experiencing any technical difficulties, there's a support button that you can click there on the bottom of your screen. And finally, the session is being recorded. All registrants will receive a follow-up email with the slides, a link to the recording, access to register for future webinar sessions, and contact details for Shaun and myself.
And we also just need to provide a general advice warning here today. So everything we're talking about is general in nature, doesn't take into account your personal circumstances and doesn't constitute legal or financial advice.
All right, so that's it for the formalities. So what are we going to go through in today's session? First up, we're going to talk about what's driving this trend of first home buyers delaying their first property purchase.
Why are parents considering helping their children get into the market?
We'll look at the various ways to provide assistance.
And also some advantages and disadvantages of each of those options.
All right, so first up, the property market and first home buyers. So we are seeing a trend occurring of first home buyers and they're delaying their first property purchase. So according to a recent research published by the Australian Housing and Urban Research Institute, or we'll call them AHURI from now on, younger generations are less likely to own a home by their early 30s than in the past. So at age 30, home ownership rates have fallen from 65% for those born in the late 1950s to around 45% for those born in the 1980s. So there's a number of social, demographic and economic influences that are contributing to this trend. Younger people are spending more time in higher education, spending time starting their careers, delaying starting families when we compare them to older generations. Housing has become less affordable over time. So one of the hurdles of home ownership is that initial deposit that you need to fork out. So banks generally require a 20% deposit towards the purchase price of the property. Otherwise, there may be additional costs such as lender's mortgage insurance, or LMI as we call it. So in addition to that 20% deposit required by the bank, your child may have to pay stamp duty, which means a higher amount of savings is needed. The level of stamp duty payable, it varies per state. I'm just conscious we have viewers in different states, and even Shaun and I are in different states. So the stamp duty payable does vary, and so do the first homeowner stamp duty concessions. They vary as well. So in the current property market, we're seeing supply side issues driving up property prices. Increases in house prices relative to income have lengthened the time needed to accumulate the deposit needed to over 6 years for those in Sydney and Melbourne, according to that AHURI report. According to other research, namely the ANZ CoreLogic Housing Affordability Report released in May 2023, the estimated time to save the required deposit amount is 9.8 years. Then another hurdle for first home buyers are the debt servicing limits. So the ANZ report we just talked about from May this year indicates that the portion of income required to service a new mortgage is 42.7%. Wages have generally risen at a slower rate than house prices. According to the Ahuri report, for every $100,000 house prices rise, households are up to 3% less likely to be able to get onto the property ladder. Recent figures show the median price in Australia's combined capital cities for houses is $882,000 and for units is $630,000.
Thanks, Kelly. And because of these struggles that you've just talked about, more and more parents are helping their children out to purchase their first property. There's a couple of reasons for that. It's partly because most of those parents have benefited from increases in property prices over time, and they've paid off their mortgages. They're now in a good situation where they're able to provide that assistance. But it's also that parents are wanting to help their children out rather than while they're alive, rather than passing that through an inheritance when they pass away. And what's driving that is the increasing life expectancy. So someone who's got a life expectancy today of 80 to 85, they might not pass through an inheritance to their kids. Their kids might be 60 or 65 by that time, and they're already through their journey. So receiving the money at that stage is a lot less impactful, than had they had received it at the start of their journey. So what we're seeing parents doing is providing assistance in a number of different ways. First off is financial assistance, like giving cash. Now there's some pretty incredible statistics here by Ahuri, which shows that a gift of $10,000 or more can increase the likelihood of a first home purchase by about 90%. Another way that parents are providing assistance is through co-residence, which is allowing the kids or encouraging the kids to stay living at home for longer. And that's usually through either allowing them to live there rent-free or paying a nominal amount of board, which is less than what they'd pay in rent if they had otherwise moved out. Now, the research also shows that each year that kids stay living at home rather than renting increases the chance of home ownership by 30 to 40%, which is pretty significant. And then lastly, we're seeing parents going as guarantors on their children's home loans. So all of these options combined, the main benefit is helping kids get their foot on the property ladder, but it's also helping to reduce or avoid having to pay lender's mortgage insurance. So lender's mortgage insurance is an insurance policy that covers the bank for any loss that's incurred where a borrower is unable to repay their loan. And Kelly, you mentioned before the average house price of 880,000 odd for the major cities in Australia. So if there's a first home buyer who only has a 5% deposit, they could pay as much as $45,000 in lender's mortgage insurance, which is quite significant in terms of that purchase price.
Absolutely, and that add-on stamp duty to that.
Yes, that's right, yeah.
So there's a number of options that we're going to talk through today in terms of parents wanting to provide assistance.
So that's gifting cash, providing a loan, going guarantor.
We've also got providing a limited security guarantee, buying the property together, and then using a family trust or a trust structure.
And Kelly, you touched on before that there are various first homeowner grants. that vary from state to state, and we haven't sort of considered the impact of any of these strategies on those grants.
Yeah, very important. All right, so Shaun, you're going to run us through the first one.
Yeah, so the gifting of cash is a pretty popular option. The main benefit is that it's the most simple method, and there are no tax implications for the giver or the receiver of that money. The main thing that parents need to be aware of is that you need to make sure that you're able to afford that and you're not sacrificing your own future goals, whether that be retirement or anything else. And if you're not sure about that, then you probably need to seek financial advice. If you're on Social Security as well, you need to consider the implications for you with the various gifting rules. And you also need to make sure that your child can actually service the loan. There's no use giving the money if they can take out a loan but then can't service it. And then just lastly is that some lenders are a little bit picky when it comes to receiving a gift rather than saving a deposit through genuine savings. So those are just some things to be aware of. But also, sorry, just one last thing is where a parent gifts money to their children, that's then an asset of the child. So they've got legal ownership of that. They don't have to repay it. And if they're in a relationship and that breaks down, then that would form part of the settlement.
Yeah, good one to be aware of. So then the next option we want to run through is providing a loan. And this is, we often see this a lot, and in parents' minds, it's very similar to giving cash, but you also structure it so it's a loan. And maybe in your mind, you have no intention for your child to ever repay that loan to you, but having the paperwork in place is going to give you some protection. And this really is a segue from that point that Shaun made about the relationship breakdown. So if you gift the cash to your child, it becomes their asset. But if you do it with loan documentation, it's going to safeguard that money, and it should be kept separate from any of their marital assets or relationship assets. So a loan agreement helps very much so in that sense. You can decide to forgive that loan, so you have that flexibility. You can either do that, forgive it while you're alive, or you can do that via your will. But the terms of the loan need to be very carefully considered for your particular family and for your particular circumstances. When setting up a loan, you can do it interest-free, or you could charge interest on that, and that's just something to be aware of. If you do a loan that's interest-free, that's not taxable income to you, but if your child is repaying the loan to you and there is interest, then that interest is taxable income. So you need to be aware of that. Also, in terms of the bank's going to assess your child's capacity to service based on having two loans. So they will see the loan that you've provided and they think, okay, well, this person needs to pay the loan back to their parents as well as be able to service the loan to us as the bank. So that's something to be aware of. And then whenever doing something like this, it is legal documentation. We think you should engage with a solicitor or an appropriate professional to prepare the loan documentation, which is going to attract costs to have that drawn up. So that professional will charge you.
So the next option we'll talk about is becoming a guarantor, which means using the equity built up in your own home as security against your child's loan. Now, what that means is it's effectively a promise to the lender that if your child's not able to make the repayments on their loan, then you'll step in and either cover them or raise a portion of the value of your home to pay that back. Now, the main benefit of this strategy, and why I see people like it, is that you don't have to front up any cash or other assets. You can just use the equity that you've already built up in your own home as security. But also it allows your child to increase their borrowing capacity. Now, the main drawback is that you're ultimately liable for that loan if your child can't repay it. And if you've used your home as security and you don't have any other assets or income to repay that loan, then you're in a bit of strife, and it means probably either selling your home or your child's home to extinguish that debt. So you need to be very confident in your child's financial situation, but also your own, and just thinking through those potential scenarios that could play out. And when it comes to, if your child's buying a house with their partner and that relationship fails, then ultimately they could lose half of the house through the property settlement, but you would still remain as guarantor for the full value of the loan. So that's just something to be aware of. And Kelly, did you want to talk through the limited security guarantee?
Yeah, absolutely. So this is a bit of a continuation. It's very similar to being a guarantor. However, in this sense, it is exactly as the name says, it is a limited security. You act as guarantor, it helps your child secure the loan, but your liability is limited, and you can choose the amount that you commit, and it's normally, you can't go over 50% of the loan value. You can use your home as equity, or you can use cash, so you have a bit of flexibility in that regard. And as soon as your child's loan to value ratio, as soon as it gets below 80%, you can essentially be released, and so you don't have to be involved anymore, and the child is completely in your child's name. So this could be a potential option. It's very similar to the guarantor, as I said, but it limits your liability. Things that you should be aware of, similar to what we said for guarantor, you need to be confident in your child's financial situation and in your own. You are liable for the amount that you guarantee. So if your child is unable to repay the loan, then you need to repay the lender. If you choose to use your home as security and you don't have cash to make a repayment, your house could be in the firing line. But while acting as guarantor, your ability to borrow may be reduced. If borrowing is something you were looking to do as part of a separate strategy for yourself, you could have a reduced capacity. So that's just another thing to be aware of.
Moving on to some of the more complex strategies, one of them is to purchase a property together with your child in an ownership that's known as tenants in common, and that just means you've got individual shares in the ownership of that property. So you might, as the parent, own 30% of that property, and your child might own 70% of that property. Now, the reason that people would do this is because usually it's done in anticipation of your child then buying you out in the future. Once they're established themselves, they've come along in their career and they're earning more money, they've paid down the loan, they're in that position to buy you out then. And the main benefit, or the reason that people like this strategy, is because it gives you a little bit more control than some of the others that we've talked about. And the reason for that is because you've got direct control or direct ownership of a portion of that property. And it also, one of the other benefits is that if that property rises in value, then your share in that property also goes up in value. Now, the main thing to consider there is that because it's an investment for yourself, it's considered an investment property. There are capital gains tax consequences where that property is sold in the future, and if there's a capital gain that's been made along the way, so you'd be liable then for capital gains tax. But if it was your child's principal place of residence, then they get the capital gains tax exemption. There wouldn't be any tax consequences for them, but there would be for yourself. You also need to be aware of that that both you and your child would still be liable for the full amount of the loan. So similarly to the other options that we've talked about, you could be on the line for repayments if your child isn't able to, for whatever reason, in the future.
Thanks, Shaun. So using a trust or a family discretionary trust is what I'm referring to here. So in this situation, a trust is a separate legal structure, and often what you do is you have you as a director, or you could be an individual trustee of the trust, or you would be a director of a company that acts as trustee for that trust, and then the trust itself could then purchase the property. This can give you flexibility and a lot of control, and then there can be change of ownership down the line. So if you were to transfer you wanted your child to have it, transfer control of the trust, to your child in the future, if you're doing it with a corporate trustee structure in place, then there should be no capital gains tax or stamp duty at that time. While you're the director of the corporate trustee, you have the control over the trust, and so there can be a lot of flexibility, but it is also a very complex structure to have in place before even considering it for this particular strategy of helping your child get into a property market. You should consider whether a trust structure is right for you, because there are costs in getting it established, and there are ongoing running costs because it is its own separate legal tax structure. It will have its own tax return and financial statements that need to be prepared each year, which involves a cost. Owning the property in this structure means that there would be no main residence exemption, or the exemption from capital gains tax, if the property is sold at a later point. And then another consideration is the land tax. So you may end up paying a higher amount because you may no longer be eligible for land tax exemptions. So those are pretty big things to be aware of and to consider, to factor into whether it's appropriate for you. So following all of that, there was a lot of points that we covered, and we've put it into a nice summary table with each of the options and the key aspects of each. So if you're in a position with your own accumulated assets, home, or perhaps you've received an inheritance and you would like to use those funds to help get your children into the property market, we hope this webinar has been informative and useful. As you can see, there are a number of options and complications that can arise. So it's really important to understand the benefits and the consequences of each of those options and seek advice to consider the most appropriate strategy for you. We are going to open up to questions. So just while we get those loading, I just want to take the opportunity to let you know about some future webinar topics that we've got coming up for the wealth space. So at the end of September, we're going to have the superannuation webinar. This is an introductory session introducing super, introducing some general concepts and contribution types. Then at the end of November, we're going to have transferring property to family. That is a follow-on to today's topic. So it's about where you have an existing property and you want to transfer that property to a family, the different options and the different considerations. And then we'll take a break for Christmas and come back and start the new year in early February with a topic on ethical or ESG investing, which is environmental, social, and governance. So applying screens and filters to your investing. So now, hopefully now we've had some questions come through. Okay, well, actually, turns out we don't have any questions, so we have sufficiently answered. Oh no, is there an issue with an interest-free loan with no repayment terms being forgiven under the statute of limitations? I don't know the answer to that question. I'm just going to be very honest. Shaun, pipe up if you have an answer on that one. That one is probably just a little bit outside my knowledge.
Yeah, I've got no idea about that either. Sorry.
Yeah, that's okay. We can take that offline, see if there's someone. We've got a wealth of knowledge of people with different areas of expertise here in BDO. So we'll see if we can find some general information to help answer that question. But if there's no other questions that anyone's submitted, we will give this a wrap. So I just want to say thank you very much to Shaun for joining me today.
Thanks,
and thank you for everyone joining.
Thanks, everyone.